Welcome back to the channel. Today we're diving deep into one of the most pressing questions in the precious metals market. Can the physical silver shortage be solved? Or are we heading toward a price explosion that could reshape the entire industry? This isn't just about investing, this is about understanding a fundamental imbalance in one of the world's most critical industrial metals. Silver sits at the intersection of investment demand, industrial necessity, and mining economics. What happens next could have profound implications for your portfolio, for technology companies, and for the global economy. By the end of this video, you'll understand the root causes of the shortage, the mechanisms that could solve it, and the scenarios that could send silver prices soaring. Let's get started. The silver market is facing something remarkable. For the first time in decades, we're seeing persistent physical shortages alongside relatively modest price increases. This disconnect tells us something important is happening beneath the surface. Global silver demand reached approximately 1.2 billion ounces in recent years, while mine supply has struggled to keep pace. The deficit isn't small. We're talking about a structural imbalance of over 200 million ounces annually. That's a gap representing nearly 20% of total supply. What makes this shortage particularly interesting is its dual nature. On one hand, industrial demand continues to climb, driven by solar panels, electric vehicles, and electronics. On the other hand, investment demand has surged as investors seek hard assets amid currency debasement and economic uncertainty. The physical market shows clear signs of stress. Premiums over spot prices have expanded significantly. Delivery delays have become common. Major mints report backlogs. Retail investors face wait times that would have been unthinkable just a few years ago. Yet the price hasn't exploded. Why? Because the paper silver market, through futures contracts and derivatives, continues to exert downward pressure. The disconnect between physical reality and paper pricing creates the central tension we're exploring today. Let's start with supply. Silver mining is more complex than most people realize. Unlike gold, silver is primarily a byproduct. Roughly 70% of mined silver comes from operations primarily extracting other metals like copper, zinc, or lead. This creates a unique problem. When copper prices fall, mines reduce production and silver supply drops as a side effect. Mining companies can't simply ramp up silver production in response to silver prices alone. The economics don't work that way. Primary silver mines face their own challenges. Ore grades have been declining for decades. Miners must process more rock to extract the same amount of silver. This increases costs, energy consumption, and environmental impact. The lead time for new mines is substantial. From discovery to production, a new silver mine typically requires 7 to 10 years. Even if prices doubled tomorrow, we wouldn't see significant new supply for nearly a decade. Existing mines are also aging. Many of the world's largest silver-producing operations have been in production for decades. Reserve replacement hasn't kept pace with depletion. Companies are mining high-grade deposits faster than they're finding new ones. Geopolitical factors compound these issues. Major silver-producing countries, including Mexico, Peru, and China, face political instability, regulatory uncertainty, and resource nationalism. Governments are increasingly asserting control over strategic resources. Environmental regulations continue to tighten. Mining projects face longer permitting processes, higher compliance costs, and greater opposition from local communities. These are necessary protections, but they constrain supply growth. The result is a supply side that responds slowly to price signals. Even substantial price increases may not trigger the supply response that classical economics would predict. Now let's examine the demand side, starting with industrial applications. This is where the story gets really interesting because industrial demand for silver is accelerating. The solar energy revolution is the single largest driver. Each solar panel contains approximately 20 grams of silver. As countries race to meet climate targets, solar installations are breaking records. The International Energy Agency projects solar capacity could triple by 2030. Do the math. If solar demand alone requires 150 million ounces annually now, and capacity triples, we're looking at 450 million ounces. That's nearly half of total current supply going to a single application. Electric vehicles represent another massive demand source. EVs use significantly more silver than internal combustion vehicles. The electrical systems, charging infrastructure, and battery management systems all require silver's unique properties. Traditional automakers are pivoting to electric. Governments are mandating the phase out of gas-powered vehicles. China, Europe, and California have set aggressive timelines. This isn't a trend you can reverse. It's a structural shift in transportation. Consumer electronics continue to consume vast quantities of silver. Every smartphone, laptop, and tablet contains silver. As global middle classes expand, especially in Asia and Africa, electronics consumption grows exponentially. 5G infrastructure demands silver. The build-out of next-generation wireless networks requires massive amounts of electrical infrastructure. Each cell tower, each network switch, each component contains silver contacts and conductors. Medical applications are expanding. Silver's antimicrobial properties make it invaluable in healthcare. From wound dressings to surgical instruments to water purification, medical demand is growing as healthcare access expands globally. Water purification systems increasingly rely on silver. As clean water becomes scarcer, silver-based purification technologies are being deployed at scale. This represents a new demand category that didn't exist a generation ago. The key point is this: industrial demand is not discretionary. Solar manufacturers can't simply stop using silver because the price rises. There's no adequate substitute for many applications. This creates inelastic demand that must be met regardless of price. Investment demand adds another layer to this story. Unlike industrial users, investors are responding to macroeconomic concerns that show no signs of abating. Central bank policies have fundamentally changed investor behavior. Years of quantitative easing, zero interest rates, and now persistent inflation have driven investors toward hard assets. Silver benefits from the shift. The ratio between gold and silver prices has historically averaged around 60 to 1. In recent periods, it's exceeded 80 to 1. Value investors see this as an opportunity. If the ratio reverts to its historical mean, silver prices must rise substantially or gold must fall. Retail investment in physical silver has exploded. During market stress, investors flock to tangible assets. The experience of 2020 demonstrated this clearly. Retail demand overwhelmed supply chains, creating premiums that persisted for months. Exchange-traded funds holding physical silver have grown dramatically. These funds must purchase and vault actual metal to back their shares. As assets under management grow, so does the drain on available physical supply. The wealth effect matters here. As stock markets create wealth, some portion flows into alternative assets. Silver attracts investors seeking portfolio diversification without the higher price point of gold. Younger investors are discovering precious metals. Social media communities dedicated to silver stacking have grown into movements. While sometimes dismissed as retail enthusiasm, these communities represent genuine demand for physical metal. Geopolitical uncertainty reinforces investment demand. From trade tensions to military conflicts to pandemic responses, the modern world feels increasingly unstable. Silver offers a form of wealth that exists outside the banking system. Currency debasement concerns are rational. Money supply growth has far outpaced economic growth. Investors holding cash see their purchasing power erode. Silver represents an alternative that governments cannot print. The important distinction is this: investment demand can be volatile. Unlike industrial demand, investors can change their minds. However, once physical metal moves from weak hands to strong hands, from traders to long-term holders, it effectively leaves the available supply. This brings us to perhaps the most controversial aspect of the silver market: the disconnect between paper trading and physical metal. The vast majority of silver trading occurs in the futures market and through derivatives. For every ounce of physical silver, there might be 100 or more ounces of paper claims. This creates massive leverage in the pricing system. The COMEX silver futures market in New York is the primary price discovery mechanism, but the amount of silver actually available for delivery is a fraction of the open interest. Most contracts are cash settled, never requiring physical delivery. Large banks act as market makers in silver derivatives. Their positions are massive relative to physical supply. When these institutions take large, short positions, they can influence prices regardless of physical market conditions. This is where things get contentious. Critics argue the paper market suppresses silver prices below where they would trade based on physical supply and demand alone. Defenders argue the futures market provides necessary liquidity and price discovery. The evidence suggests both sides have valid points. On one hand, futures markets do provide genuine benefits. They allow producers to hedge, consumers to lock in prices, and investors to gain exposure efficiently. On the other hand, the massive leverage in paper silver creates dynamics impossible in physical markets. You can't short 100 million ounces of physical silver you don't have, but you can absolutely sell 100 million ounces of paper silver. What happens when this tension breaks? If enough market participants demand physical delivery, the system faces stress. We've seen glimpses of this during periods of high demand. Premiums spike, delivery delays extend, and the paper price becomes increasingly disconnected from physical reality. The key question is whether this two-tiered market can persist indefinitely. Some argue it can, pointing to decades of stability. Others argue that every leverage-based system eventually faces a reckoning. Let's explore the first potential solution: ramping up mining production. On the surface, this seems obvious. Prices rise, miners produce more, shortage solved. But reality is far more complex. First, the time lag. Even if every silver mining company started new projects today, meaningful production wouldn't arrive for years. Exploration, permitting, development, and construction take time. The shortage is happening now. Second, the economics. At current prices, many potential silver deposits aren't profitable to develop. Mining costs have risen steadily due to declining ore grades, deeper deposits, and stricter environmental requirements. What price level makes new projects viable? Analysts suggest primary silver mines need prices around $25 to $30 per ounce to justify development. We've touched those levels, but sustained prices above that range would be necessary to trigger investment. Even at higher prices, capital is constrained. Mining companies compete for investment capital with countless other opportunities. After years of underperformance, silver miners struggle to attract the capital needed for major expansions. The technical challenges are real. Easy-to-mine deposits were developed long ago. New discoveries tend to be deeper, lower grade, or in remote locations. This increases both capital requirements and operating costs. Environmental and social opposition has intensified. Communities near proposed mines are more organized and vocal. NGOs scrutinize projects more carefully. Governments face pressure to deny permits, even for economically viable deposits. Resource nationalism is rising. Countries rich in silver are questioning whether they should export raw materials or develop downstream industries. Mexico, Peru, and others have implemented or considered policies that constrain mining expansion. There's also the byproduct problem we mentioned earlier. Since most silver comes from copper, zinc, and lead mines, increasing silver supply requires increasing production of those metals. But that depends on demand for those base metals, not for silver. The realistic assessment is this. Mining can increase supply, but only gradually, only with sustained high prices, and only if numerous other conditions align. It's not a quick fix to the current shortage. Recycling represents another potential supply source. Unlike many industrial metals, silver is highly recyclable. It doesn't degrade through recycling, and its value makes recovery economically viable. Currently, recycled silver provides roughly 15% of total supply. This comes primarily from industrial scrap, photography waste, and jewelry. The percentage has been relatively stable for years. Could recycling dramatically increase? In theory, yes. Vast quantities of silver sit in landfills, old electronics, and forgotten items. If prices rose high enough, more of this material would be economically recoverable. The reality is more nuanced. Much of the silver in consumer electronics exists in tiny quantities per device. Recovery is labor-intensive and requires sophisticated processes. Current recycling infrastructure isn't designed to handle massive increases. Photography represents a declining source. The shift to digital has eliminated the largest historical recycling stream. Silver recovered from X-ray film and photographic processing has dropped dramatically. Jewelry recycling responds to price. When silver hits high levels, more people sell old jewelry, providing supply to the market. But this is ultimately limited. Once grandma's silver tea set is melted down, it can't be recycled again. Industrial recycling is already quite efficient. Companies that use silver in manufacturing have strong incentives to recover and recycle. Most low-hanging fruit has been picked. The emerging challenge is complexity. Modern applications use silver in ways that make recovery difficult. Solar panels, for example, contain silver but require energy-intensive processes to reclaim it. At current prices, much of this recycling isn't economic. There's also a time dimension. Silver in solar panels installed today won't be available for recycling for 25 or 30 years. Same with many other long-lived applications. This silver is effectively removed from circulation for decades. Higher prices would certainly stimulate more recycling. But the response would be gradual and limited by infrastructure, technology, and the physics of material recovery. Recycling can help, but it's unlikely to completely solve a major shortage. What about substitution? Can industries simply switch to alternative materials? This is where silver's unique properties become crucial. Silver is the most electrically conductive element on Earth. It's also the most thermally conductive and the most reflective. These aren't marginal advantages. Silver is measurably superior to alternatives. For some applications, alternatives exist but perform worse. Copper can substitute for silver in electrical applications, but has 5% lower conductivity. In high-performance applications, that difference matters. In solar panels, researchers have worked for years to reduce silver content. They've made progress, with silver loading per panel declining. But eliminating silver entirely has proven extremely difficult without sacrificing efficiency. The economics of substitution matter. If a solar panel costs $500 and contains $20 of silver, even doubling the silver price adds only $20 to the panel cost. For a product lasting 25 years, that's minimal. Compare that to the cost of redesigning the panel to use less silver, retooling manufacturing, and potentially reducing efficiency. Often, paying more for silver is the economical choice. Some applications have no viable substitute at current technology levels. Silver's antimicrobial properties can't be replicated by other materials. Its reflectivity is essential for mirrors and specialized optical applications. The substitution that has occurred generally involves reducing usage rather than eliminating it. Manufacturers use thinner coatings, more precise application, and improved recovery of waste. but they still use silver. Technology could change this equation. If scientists discover or engineer materials with silver-like properties at lower cost, substitution could accelerate. But materials, science moves slowly, and no such breakthrough is imminent. The rational expectation is that substitution will continue at the margins. Companies will use less silver per unit where possible, but complete substitution in critical applications remains technologically infeasible or economically unattractive. This brings us to the fundamental economic question. At what price does the market clear? Price is the ultimate balancing mechanism between supply and demand. Classical economics suggests that prices rise until demand destruction occurs and supply increases sufficiently to restore equilibrium. But silver's characteristics complicate this simple model. On the demand side, industrial applications show low price elasticity. A solar manufacturer might tolerate silver at $30, $50, or even $100 per ounce before redesigning products. The silver cost is small relative to the total product value. Investment demand might actually increase with price. Higher prices attract momentum investors and validate the investment thesis. Unlike most goods, precious metals can exhibit positive price elasticity of demand within certain ranges. On the supply side, the response is sluggish. We've discussed the years required to bring new mines online. Even dramatic price increases don't generate immediate supply responses. This creates the possibility of price spikes. If demand continues growing while supply remains constrained, prices could rise sharply before meaningful supply responses occur. The market might overshoot equilibrium significantly. Historical precedents exist. In 1980, silver briefly touched $50 per ounce in inflation-adjusted terms, far higher than fundamentals justified. The spike was driven by the Hunt brothers' attempt to corner the market, but it demonstrates silver's volatility potential. More recently, in 2011, silver reached nearly $50 again amid post-financial crisis monetary expansion. The spike proved temporary, but it showed how quickly prices can move when investment demand surges. The question investors face is whether the current situation could trigger a similar move. The supply deficit is real and growing. Industrial demand appears structural rather than cyclical. Investment demand remains elevated. What price level would actually balance the market? Analysts offer a wide range. Some suggest $30 to $40 would stimulate enough supply and demand destruction. Others argue that $50, $75, or even $100 might be necessary given the structural nature of the deficit. The honest answer is that nobody knows. Markets are complex adaptive systems. Price discovery happens through the actions of millions of participants, each with different information and motivations. Government actions represent another critical variable that could either solve or exacerbate the shortage. Unlike gold, governments don't typically hold large strategic silver reserves. This could change. China has been accumulating strategic reserves of critical materials. And while official data is limited, evidence suggests China has been building silver stockpiles alongside lithium, rare earths, and other strategic metals. If other countries follow suit, treating silver as a strategic resource for green energy transitions, demand could spike dramatically. Government buying is typically price insensitive, especially when motivated by strategic rather than economic considerations. Conversely, governments could release strategic stockpiles to ease shortages. However, without large existing reserves, this option isn't available for most countries. The United States sold its strategic silver stockpile years ago. Policy around mining could dramatically affect supply. Streamlined permitting, tax incentives, and regulatory support could accelerate mine development. Alternatively, stricter environmental rules could further constrain supply growth. Trade policies matter enormously. Tariffs, export restrictions, or import controls on silver or silver-bearing products could fragment the global market. Countries might hoard domestic production, reducing globally available supply. Green energy subsidies indirectly affect silver demand. Government support for solar, EVs, and other technologies that consume silver increases demand. These policies aren't going away. They're intensifying. Central bank monetary policy shapes investment demand. If inflation remains elevated or currencies continue depreciating, investors flee to hard assets. If central banks successfully stabilize purchasing power, investment demand might moderate. The geopolitical dimension is increasingly important. As countries compete for technological supremacy and energy security, silver's role in electronics and green energy makes it strategically significant. The uncertainty around government actions makes forecasting particularly difficult. A single policy change could shift the supply-demand balance by millions of ounces. Let's now explore the possible scenarios for how this situation resolves. Understanding the range of outcomes helps us prepare regardless of which path materializes. Scenario 1. Gradual adjustment. Prices rise moderately to the $35 to $45 range. This stimulates some supply response from existing mines, encourages recycling, and causes marginal demand destruction. The shortage eases over 3 to 5 years as the market gradually rebalances. In this scenario, mining companies increase production from existing operations. Some marginal projects become economic and proceed. Industrial users absorb higher costs, passing them to consumers. Investment demand remains elevated but doesn't accelerate dramatically. This is arguably the most probable scenario. Markets tend toward equilibrium, even if the path is messy. It implies meaningful upside from current levels, but not a dramatic spike. Scenario 2, technological breakthrough. Researchers develop effective substitutes for key applications, particularly solar panels. Or new extraction technologies dramatically reduce mining costs, unlocking previously uneconomic deposits. This scenario would ease the shortage through the supply side or demand side. Prices might stabilize or even decline as the structural deficit closes. Investors betting on shortage-driven price increases would be disappointed. The probability here is harder to assess. Technological progress can surprise, but given the lack of imminent breakthroughs in either substitution or extraction, this seems less likely in the near term. Scenario 3, price spike. Investment demand accelerates as the shortage becomes widely recognized. The gap between paper and physical markets causes a crisis of confidence in futures markets. Prices spike to 75, 100, or higher in a short period. This scenario involves positive feedback loops. Rising prices attract more investors. Physical delivery demands stress the paper market. The shortage becomes self-reinforcing as users and investors both scramble to secure supply. Historical precedents exist, as we discussed. The conditions for such a spike appear to be building. Whether it materializes depends on catalysts, like a squeeze in futures markets or a sudden surge in investment demand. Scenario 4, policy intervention. Governments conclude that silver shortages threaten critical industries. They implement emergency measures, releasing stockpiles where available, fast-tracking mine approvals, or restricting exports and investment demand. This could prevent a price spike, but might create other distortions. Black markets could emerge, hoarding might increase. The free market price mechanism would be overridden by political decisions. This scenario seems plausible if shortages become acute enough to threaten strategic industries. Governments historically intervene when markets for critical materials dislocate. Scenario 5, prolonged shortage. The deficit persists for years. Prices rise, but not dramatically. The paper market maintains price suppression. Physical premiums widen enormously, creating a two-tier market where paper and physical trade at increasingly different levels. In this scenario, retail investors pay large premiums for physical metal while the futures market shows modest price increases. Industrial users face allocation challenges. The market functions, but remains stressed. This could persist if the paper market maintains liquidity and confidence despite physical tightness. It's an unstable equilibrium, but could last longer than many expect. What does all this mean for investors considering silver? The implications depend heavily on your objectives, time horizon, and risk tolerance. For those seeking portfolio diversification, silver offers exposure to a tangible asset with supply constraints. The allocation doesn't need to be large. Even 5 to 10% in precious metals provides meaningful diversification. The case for physical silver rests on the structural deficit and limited supply responsiveness. If the shortage persists or worsens, physical holders benefit directly. The premiums you pay today could seem small if the shortage intensifies. Silver mining stocks offer leveraged exposure to silver prices. When silver rises, mining companies' profits can increase disproportionately. But miners carry operational risks, management risks, and political risks that physical silver doesn't. ETFs provide convenient exposure without storage concerns. However, ensure you understand whether the ETF holds physical metal or derivatives. Physical-backed ETFs offer more direct exposure to the shortage thesis. The timing question is challenging. Silver is notoriously volatile. Trying to time an entry perfectly is difficult. Dollar cost averaging, buying consistently over time, reduces timing risk. Consider the opportunity cost. Silver doesn't generate yield like bonds or dividends like stocks. Its return comes entirely from price appreciation. In an environment where other assets offer attractive yields, this matters. Your time horizon is crucial. If you might need the capital in months, silver's volatility creates risk. If your horizon is 5 or 10 years, short-term volatility matters less than the long-term supply-demand fundamentals. The tax treatment of physical silver varies by jurisdiction. In some countries, silver sales trigger capital gains taxes or even sales taxes. Understand the tax implications before committing significant capital. Storage and insurance represent real costs for physical silver. These ongoing expenses reduce your net return. Factor them into your calculations when comparing silver to other investments. The counterargument to silver investment is that the shortage might never translate to dramatic price increases. Paper markets might maintain price suppression. Substitution might accelerate. Government policies might change. Investors should also consider correlation. Silver correlates with gold, but has its own dynamics. It correlates somewhat with industrial metals due to industrial demand. Understanding these relationships helps in portfolio construction. From an industrial standpoint, companies that rely on silver face strategic decisions. How they respond to the shortage could influence the broader market. Some companies are forward buying, securing supply months or years in advance. This provides certainty but locks in prices and requires capital. It also removes silver from the spot market, potentially intensifying shortages. Others are accelerating research into silver reduction or substitution. Even if complete substitution isn't possible, reducing silver content per unit helps. This approach takes time but offers long-term supply security. Vertical integration represents another strategy. Some manufacturers are establishing relationships directly with miners or recyclers, bypassing traditional supply chains. This provides more control, but it requires expertise and capital. Companies might also consider strategic stockpiling, building inventory during periods of availability to cushion against future shortages. This is expensive and ties up capital, but reduces operational risk. The pass-through question looms large. Can companies raise prices to offset higher silver costs? In competitive markets with price-sensitive customers, passing through costs is difficult. In markets with pricing power, it's easier. For some industries, silver costs remain small relative to total product value. Solar manufacturers, for instance, can absorb significant silver price increases without major business model disruption. Other industries might struggle more. Applications where silver represents a larger cost component face tougher choices. These sectors show stronger incentives to find substitutes or reduce usage. The shortage could drive consolidation. Smaller companies without purchasing power or the resources to secure supply might struggle. Larger firms with strategic relationships and financial strength might gain market share. Industrial users also monitor the investment market closely. If investment demand surges, it competes directly with industrial demand. Some companies fear that investor hoarding could starve industrial supply chains. The relationship between industrial users and the futures market is complex. Companies use futures to hedge, but if the paper market loses credibility, hedging becomes unreliable. This could force more direct physical procurement. So can the physical silver shortage be solved, or will it boost prices dramatically? After examining all the factors, here's the balanced assessment. The shortage is real and structural. This isn't a temporary imbalance that resolves quickly. Industrial demand is growing for fundamental long-term reasons. Supply can't respond quickly, even with price incentives. Can it be solved? Eventually, yes. High enough prices will stimulate supply, encourage substitution, and moderate discretionary demand. The market will find an equilibrium. The question is what price level that equilibrium requires. The evidence suggests current prices are too low to balance the market. The deficit persists at these levels. A meaningful price increase appears necessary to stimulate sufficient supply response and demand adjustment. How high do prices need to go? That's the trillion-dollar question. Conservative estimates suggest $30 to $40 might suffice. More aggressive analyses point to $50, $75, or higher, especially if investment demand surges. The path matters as much as the destination. A gradual rise to $40 over 5 years has very different implications than a spike to $75 in 6 months. Volatility is perhaps the only certainty. The wildcard is the paper versus physical market. If that tension breaks decisively in favor of physical, we could see a disorderly repricing. This represents the tail risk that could lead to dramatic price increases. For investors, silver presents both opportunity and risk. The fundamental case rests on a supply deficit that shows no signs of closing at current prices. But timing and execution matter enormously. For industries, proactive management of silver procurement represents prudent risk management. Waiting for the market to sort itself out could leave companies scrambling when shortages intensify. The broader lesson is about resource scarcity in an age of energy transition. Silver is just one of many materials where demand is accelerating while supply struggles to keep pace. This pattern will likely repeat with lithium, cobalt, rare earths, and other critical materials. Understanding these dynamics helps us prepare for a world where resource constraints interact with technological transformation and monetary instability. Silver is a microcosm of larger forces shaping the global economy. The silver shortage represents a fascinating intersection of geology, economics, technology, and human behavior. It's a reminder that markets, even sophisticated modern markets, can experience genuine supply constraints. Whether this translates to a price explosion depends on variables that remain uncertain. Government policies could change. Technology could surprise. Investment flows are inherently unpredictable. What we can say with confidence is that the current situation is not sustainable. The deficit must close. That closure will involve some combination of higher prices, increased supply, demand destruction, and technological adaptation. The magnitude and timing remain unknown, but the direction seems clear. Silver prices have significant upside potential based on fundamentals, even if the path includes volatility and setbacks. For those willing to accept the volatility and opportunity cost, silver offers exposure to a genuine supply shortage in a tangible asset. For those less comfortable with such risks, understanding these dynamics still provides valuable context for the broader economy. Thank you for watching. I hope this deep dive has given you a comprehensive understanding of the silver shortage and its potential implications. If you found this valuable, please like, subscribe, and share. The question isn't just whether silver prices will rise. It's whether you'll be positioned correctly when the shortage reaches its resolution, whatever form that takes. Until next time, stay informed and invest wisely.